Imagine graduating from college on one of the happiest days of your life. You walk across the stage, receive your degree, celebrate with your family, and feel ready to begin your future. You believe that all the years of studying, exams, and hard work will lead to better opportunities, a stable job, and financial independence. But for millions of Americans, that exciting moment comes with a hidden burden, a massive amount of debt that may take decades to repay. In the United States today, student loan debt has become one of the most serious personal finance problems facing young adults. Many graduates leave college not only with a diploma, but also with tens of thousands of dollars in loans. Some owe so much that it affects major life decisions, whether to buy a home, start a family, launch a business, or even choose a career they're passionate about. My name is Bryony, and I spend way much time thinking about why people who look financially reckless are sometimes better prepared for disaster than people who did everything right. If you've ever felt vaguely unsettled about how dependent your entire financial life is on one company, subscribe and hit. To understand the scale of the issue, consider this. Student loan debt in the United States has grown to more than $1.7 trillion. That makes it one of the largest categories of consumer debt in the country, second only to mortgages. Over 40 million Americans currently owe money for student loans. For many borrowers, repayment can last 10, 20, or even 30 years. This situation is often referred to as the student loan debt crisis. It is called a crisis because the problem has grown rapidly over time and has begun to affect not only individuals, but also the broader economy. Young people delay buying homes, delay saving for retirement, and sometimes struggle to meet basic living expenses because of their loan payments. Government agencies such as the U.S. Department of Education manage the federal student loan system, while many private lenders also provide education loans. The system was originally designed to make higher education more accessible. However, rising tuition costs and increasing borrowing have turned what was once a helpful program into a financial challenge for millions. To understand the crisis, it is important to first understand what student loans are and how they work. Student loans are a form of financial aid that allows students to borrow money to pay for college expenses. These expenses may include tuition, textbooks, housing, transportation, and other living costs. Unlike scholarships or grants, student loans must be repaid with interest. In the United States, student loans generally fall into two main categories: federal student loans and private student loans. Federal student loans are provided by the U.S. government. These loans are often considered safer for students because they usually have lower interest rates and more flexible repayment options. The federal government also offers programs that allow borrowers to pause payments or adjust them based on income. Private student loans, on the other hand, are offered by banks, credit unions, and other financial institutions. These loans often have higher interest rates and fewer repayment protections. Students typically begin repaying their loans after graduating or leaving school. However, depending on the amount borrowed, the monthly payments can be significant. Many borrowers struggle to balance loan payments with other financial responsibilities, such as rent, healthcare, and transportation. Student loan debt in the United States did not become a crisis overnight. Instead, it developed gradually over several decades. In the 1980s and 1990s, borrowing for college was relatively manageable for most students. Tuition costs were lower, and many families could cover a larger portion of education expenses. However, beginning in the early 2000s, the cost of higher education began to rise much faster than inflation and household income. Colleges and universities increased tuition, and students increasingly relied on loans to cover the difference. As tuition rose, borrowing increased as well. Over time, the total amount of student loan debt in the country grew dramatically. Today, student loan debt has surpassed both credit card debt and auto loan debt in the United States. This growth has been closely monitored by institutions such as the Federal Reserve, which tracks trends in consumer debt and economic stability. One of the key factors behind the student loan crisis is the rising cost of higher education. Several factors have contributed to increasing tuition prices. First, many public universities have experienced reduced government funding over the years.
When states cut funding for higher education, universities often raise tuition to make up the difference. Second, colleges have expanded their facilities and services. Modern universities often invest in new buildings, advanced technology, student recreation centers, and administrative staff. While these improvements can enhance the student experience, they also increase operating costs. Third, the demand for higher education has grown significantly. More students are pursuing college degrees than ever before, which has increased competition and demand for university resources. As a result, the average cost of attending college in the United States has increased dramatically over the past few decades. To better understand the problem, it helps to look at the typical amount of debt students graduate with. The average student loan borrower in the United States owes approximately $30,000 to $40,000 after completing a bachelor's degree. However, some borrowers accumulate much higher amounts, especially those who attend private universities or graduate programs, such as medical school or law school. Even smaller amounts of debt can create financial pressure, especially for graduates who enter lower-paying fields, such as education, social work, or public service. Student loan debt does not only affect finances, it can also have serious psychological and emotional effects. Many borrowers experience stress and anxiety related to their loan balances. Seeing a large debt amount that may take decades to repay can feel overwhelming. Some graduates report feeling trapped by their loans, especially if their income is not high enough to make significant progress on repayment. Financial stress can also influence career decisions. Instead of pursuing jobs that align with their interests or values, some graduates choose higher-paying careers simply to manage their loan payments. In addition, student debt can delay major life milestones. Research has shown that borrowers often delay buying homes, getting married, or starting families because of their financial obligations. The student loan debt crisis is not only a personal problem, it is also a national economic issue. When millions of people devote a large portion of their income to loan repayment, they have less money available for other spending. This can slow economic growth because consumers spend less on housing, travel, entertainment, and other goods and services. Economists and policymakers have begun to view student loan debt as a broader economic challenge that requires careful attention. Understanding the scale of the student loan debt crisis is only the beginning. To fully grasp the issue, we must also explore the deeper causes behind this rapid growth in borrowing and the structure of the American higher education financing system. In the next section, we will examine the major factors that created the student loan crisis, including rising tuition costs, government policy decisions, and the role of financial institutions in student lending.
However, to truly understand the crisis, it is important to explore why student loan debt grew so rapidly in the United States. The problem is not caused by just one factor. Instead, it is the result of several interconnected forces, including rising tuition costs, government policy decisions, economic changes, and the structure of the student loan system itself. In this section, we will examine the key causes behind the student loan crisis and explain how the American student loan system operates. One of the most significant factors behind the student loan crisis is the dramatic increase in college tuition over the past several decades. In the United States, the cost of higher education has increased far faster than inflation and household income. While wages for many workers have grown slowly, the price of attending college has risen sharply. This means that families today often need to borrow much more money to pay for the same education that previous generations could afford with fewer loans. For example, in the 1980s, the cost of attending a public university was relatively affordable for many middle-class families. Students could often pay a large portion of tuition through part-time jobs or family support. Today, however, the situation is very different. Tuition at many universities has increased several times over. When combined with housing, textbooks, transportation, and other living expenses, the total cost of attending college can reach tens of thousands of dollars per year. Because of these rising costs, students frequently rely on loans to cover the difference between what they can afford and what their education actually costs. Another important factor contributing to rising tuition is the decline in government funding for public universities.
In the past, state governments in the United States provided substantial financial support to public colleges and universities. This funding helped keep tuition relatively low for students. However, over the past few decades, many state governments have reduced their financial contributions to higher education. When universities receive less public funding, they often compensate by increasing tuition fees. This shift means that the financial burden of higher education has gradually moved away from governments and towards students and their families. Because many students cannot pay these higher costs up front, they often turn to loans. Another factor behind the growth of student debt is the increasing demand for college education. In modern economies, a college degree is often seen as essential for securing stable employment and higher salaries. Many employers require a bachelor's degree for positions that previously did not require one. As a result, more young people feel pressure to attend college in order to remain competitive in the job market. While this increased demand has expanded access to higher education, it has also contributed to rising costs and greater reliance on borrowing. Students often view taking out loans as an investment in their future earning potential. However, this assumption does not always guarantee financial success after graduation. To help students afford higher education, the U.S. government offers federal student loans through programs managed by the U.S. Department of Education. Federal student loans are designed to make education accessible to students from a wide range of economic backgrounds. These loans typically offer several advantages compared with private loans. First, federal loans often have lower interest rates. This helps reduce the long-term cost of borrowing. Second, federal loans provide flexible repayment options. Borrowers may choose repayment plans that adjust monthly payments based on their income. Third, federal loans offer certain protections, such as temporary payment pauses during financial hardship. Despite these benefits, federal student loans still represent a significant financial obligation that borrowers must eventually repay. In addition to federal loans, many students also rely on private student loans. Private loans are offered by banks, credit unions, and financial companies. Unlike federal loans, private loans often have fewer borrower protections and may carry higher interest rates. Interest rates on private loans may also depend on the borrower's credit score or the credit score of a cosigner, such as a parent. Private student loans can therefore be riskier for borrowers, particularly if they experience financial difficulties after graduation. One of the major reasons student debt can become overwhelming is the effect of interest over time. When students borrow money, they must repay not only the original loan amount but also interest. Interest is essentially the cost of borrowing money. For example, if a student borrows $30,000 and the interest rate is several percent per year, the total repayment amount may eventually exceed $40,000 or more. Because repayment periods often last 10 to 20 years, interest can significantly increase the overall cost of education. For some borrowers, monthly payments may cover only a portion of the interest, which means the total loan balance may decrease very slowly. To help borrowers manage their loans, the federal government has introduced several repayment programs that adjust payments based on income. Under these programs, borrowers typically pay a percentage of their income toward their student loans each month. If their income is low, their monthly payments may also be lower. These programs can make repayment more manageable for borrowers with modest salaries, especially in careers such as teaching or public service. However, while income-driven repayment plans reduce monthly payments, they can also extend the repayment period, meaning borrowers may remain in debt for many years. Some borrowers may qualify for loan forgiveness programs, which cancel part or all of their remaining student debt after a certain period. One example is the Public Service Loan Forgiveness Program. This program offers loan forgiveness for borrowers who work in qualifying public service jobs and make consistent payments for several years. Although such programs can provide relief, they often have strict eligibility requirements and can be difficult to navigate. As a result, many borrowers continue to struggle with repayment despite the availability of assistance programs. Another important aspect of the student loan crisis is economic inequality. Students from lower income families often rely more heavily on loans because they have fewer financial resources to pay for college. This means that the burden of student debt may fall disproportionately on those who already face financial challenges. Additionally, borrowers who struggle to find high-paying jobs after graduation may have greater difficulty repaying their loans. As a result, student debt can sometimes reinforce existing economic inequalities rather than reduce them.
However, understanding the causes of the crisis is only part of the story. The real importance of this issue lies in how it affects people's lives and the broader economy. Student loan debt influences major life decisions, financial stability, mental health, and even long-term economic growth. In this section, we will examine how student loan debt affects individuals, families, and the United States economy as a whole. For many Americans, student loan repayment begins shortly after they graduate from college. Most borrowers receive a short grace period of about 6 months before their first payment becomes due. At this stage of life, many graduates are just beginning their careers. Entry-level salaries are often modest, while living expenses such as housing, transportation, and healthcare can be significant. As a result, monthly student loan payments can place considerable pressure on a young graduate's budget. For example, a borrower who owes $30,000 may need to make monthly payments of several $100s, depending on the repayment plan and interest rate. For someone earning an entry-level salary, this can represent a large portion of their income. This financial burden can make it difficult for graduates to build savings, invest for the future, or manage unexpected expenses. Student loan debt often delays the financial independence of young adults. Many graduates must continue living with their parents or share housing with roommates for longer periods because they cannot afford independent living while paying their loans. This delay in financial independence can affect personal development and life planning. Graduates may postpone moving to new cities, pursuing certain career opportunities, or making major financial decisions because they feel constrained by their debt. In some cases, individuals even delay pursuing further education because they are still paying off previous loans. One of the most widely discussed consequences of student loan debt is its impact on home ownership. Buying a home is traditionally considered a major step toward financial stability in the United States. However, student loan debt can make it more difficult for young adults to qualify for mortgages. Lenders evaluate a borrower's debt-to-income ratio, which compares monthly debt payments to income. When student loan payments are high, this ratio increases, making it harder to qualify for a home loan. Research from institutions such as the Federal Reserve has shown that higher levels of student debt are associated with lower rates of home ownership among young adults. As a result, many graduates postpone buying homes until they reduce their debt or increase their income. Student loan debt can also affect personal and family decisions. Many borrowers delay major life events such as marriage or having children because they feel financially unprepared. Raising a family requires stable income, savings, and housing security. For individuals struggling with loan payments, these goals may seem difficult to achieve. Some surveys show that borrowers with significant student debt are more likely to postpone starting families compared with those without debt. While student loans are not the only factor influencing family decisions, they can contribute to financial uncertainty during important life stages. Another significant effect of student loan debt is its influence on career decisions. Graduates who carry large amounts of debt may feel pressure to pursue higher-paying jobs rather than careers they are passionate about. For example, a graduate interested in public service, education, or nonprofit work may hesitate to enter those fields if the salaries are not high enough to support their loan payments. This can create challenges for sectors that rely on highly educated professionals but offer relatively modest wages. To address this issue, the federal government has introduced loan forgiveness programs for certain public service careers through programs managed by the U.S. Department of Education. These programs aim to encourage graduates to work in areas such as teaching, healthcare, and government service. However, these programs are not always accessible or simple to navigate, which means many borrowers still face difficult career choices. The financial burden of student loan debt can also affect mental health. Many borrowers experience stress and anxiety related to their financial obligations. Seeing a large loan balance that may take decades to repay can create feelings of uncertainty and pressure. Some borrowers report feeling discouraged when they notice that their loan balance decreases very slowly due to interest accumulation. Financial stress can also affect relationships, work performance, and overall well-being. Although debt is a common part of modern financial life, the scale and duration of student loan repayment can make it particularly challenging for many individuals. The student loan crisis does not only affect individual borrowers, it also has broader economic implications. When millions of people must devote a large portion of their income to debt repayment, they have less money available for spending on goods and services. Consumer spending is a major driver of economic growth in the United States. When spending slows, businesses may experience reduced demand, which can affect investment and job creation. Economists therefore pay close attention to student loan trends when evaluating the health of the national economy. Student loan debt can also reduce long-term savings and investment. Many borrowers struggle to contribute to retirement savings while making loan payments. As a result, they may start saving for retirement later than previous generations. This delay can significantly impact long-term wealth accumulation because retirement investments rely heavily on compound growth over time. Some borrowers also postpone investing in the stock market or other assets while focusing on debt repayment. These delays can reduce financial security later in life. Another important aspect of the student loan crisis is its relationship with social inequality. Students from wealthier families may be able to pay for college without borrowing, or may borrow significantly less. In contrast, students from lower-income families often rely heavily on loans to finance their education. This means that individuals who already face financial challenges may graduate with the largest debt burdens. If these borrowers struggle to find well-paying jobs, the debt may become even harder to repay. As a result, student loan debt can sometimes reinforce existing economic inequalities rather than reduce them. Because of these widespread effects, the student loan crisis has become an important topic of public discussion in the United States. Policymakers, economists, and citizens continue to debate how it should be addressed. Some argue for large-scale debt cancellation programs, while others support reforms that would reduce borrowing in the future. The debate reflects the complexity of balancing access to education with financial sustainability.
Policymakers, economists, educators, and citizens have proposed many different solutions. Some focus on helping current borrowers manage or reduce their debt. Others aim to prevent future generations of students from facing the same financial burden. In this final section, we will examine several of the most widely discussed solutions and consider their potential advantages and challenges. One of the most widely debated solutions is student loan forgiveness. This approach involves canceling some or all of the student loan debt that borrowers currently owe. Supporters of loan forgiveness argue that it could provide immediate financial relief to millions of Americans. Reducing or eliminating student debt could allow borrowers to spend more money on housing, businesses, and other economic activities, which might stimulate economic growth. Some proposals suggest canceling a fixed amount of debt for each borrower, such as $10,000 or $20,000. Others propose broader programs that would forgive a larger portion of debt, particularly for borrowers with low incomes. Loan forgiveness programs are typically managed through the federal student loan system under the authority of the U.S. Department of Education. However, loan forgiveness is also controversial. Critics argue that large-scale debt cancellation could be expensive for taxpayers and may unfairly benefit borrowers who already completed college while providing no assistance to those who did not attend college or who have already repaid their loans. Because of these debates, large-scale forgiveness programs remain a topic of ongoing political discussion. Another commonly proposed solution is improving income-driven repayment plans. These programs allow borrowers to repay their loans based on a percentage of their income rather than a fixed monthly payment. If a borrower earns less money, their monthly payment is reduced accordingly. Many policymakers support expanding these programs so that borrowers can more easily manage their debt without experiencing financial hardship. Reforms could include lowering the percentage of income required for payments or shortening the time period before remaining balances are forgiven.
Income-driven repayment programs aim to ensure that student loan payments remain manageable while still requiring borrowers to contribute toward repayment. Some policymakers advocate expanding loan forgiveness programs for individuals working in public service careers. Programs such as public service loan forgiveness encourage graduates to work in fields that benefit society, including education, healthcare, government, and nonprofit organizations. Under this program, borrowers who make consistent payments for a certain number of years while working in qualifying public service jobs may have their remaining loan balances forgiven. Expanding these programs could encourage more graduates to pursue careers that serve communities while also helping them manage their student debt. While many proposed solutions focus on existing borrowers, others aim to address the root cause of the crisis, the high cost of college. One possible solution is increasing government funding for public universities. Greater public investment could allow universities to lower tuition and reduce the need for student borrowing. Some policymakers also support programs that provide free or reduced cost education at community colleges. Community colleges typically offer lower tuition rates and can provide an affordable path to higher education. If more students begin their education at community colleges before transferring to universities, they may graduate with significantly less debt. Another important strategy involves improving financial education for students and families. Many young people take out student loans without fully understanding the long-term consequences of borrowing large amounts of money. Providing clearer information about loan terms, interest rates, and repayment expectations could help students make more informed decisions about financing their education. Financial literacy programs could also help students compare education costs, explore scholarships, and consider alternative career paths that may require less borrowing. Another potential solution is expanding awareness of alternative education pathways. While traditional four-year university degrees are often viewed as the standard path to success, other options can provide valuable skills and career opportunities. Technical training programs, trade schools, and apprenticeship programs can prepare students for well-paying careers in fields such as construction, technology, healthcare support, and manufacturing. These programs often cost significantly less than traditional university degrees and may allow students to enter the workforce more quickly. Encouraging diverse educational pathways can help reduce reliance on student loans while still supporting career development. Government economic policies also play an important role in addressing the student loan crisis. Institutions such as the Federal Reserve monitor economic conditions and analyze how student debt affects consumer spending, housing markets, and long-term economic growth. Understanding these broader economic effects can help policymakers design strategies that support both borrowers and the national economy. The student loan debt crisis developed over many years, and solving it will likely require a combination of different approaches. Some solutions will focus on helping existing borrowers manage their debt, while others will aim to prevent future generations from accumulating similar levels of borrowing. Successful reform may require cooperation among governments, educational institutions, financial organizations, and students themselves. Because higher education plays such an important role in economic opportunity and innovation, ensuring that it remains accessible and affordable is a critical goal for the future. The student loan debt crisis represents one of the most significant personal finance challenges facing the United States today. Millions of Americans rely on student loans to pursue higher education and improve their career prospects. However, rising tuition costs and increased borrowing have created a situation in which many graduates begin their professional lives with substantial financial obligations. We've seen how this debt affects not only individual borrowers, but also broader economic trends. Student loans can influence career choices, delay major life decisions, and reduce financial stability for many young adults. At the same time, higher education remains an important pathway to opportunity and economic mobility. Finding the right balance between access to education and financial sustainability will be essential in addressing this crisis. As policymakers and society continue to debate solutions, one key principle remains clear. Education should open doors to opportunity, not create barriers that limit financial freedom. By improving affordability, strengthening repayment systems, and expanding financial awareness, it may be possible to create a more sustainable and equitable system of higher education financing for future generations.